Okay, great. Well, hey, welcome aboard, everybody. This is Ken Calhoun, Daytrading University, Trade Mastery, Stock Trading Success, and other sites. I wanted to welcome you to today's session on how to trade high momentum breakouts using MetaStock, and we're going to be looking at some new strategies for our current markets. I don't know if anyone else was trading or following the gold miner sell-off and meltdown earlier today, ABX, Newmont, GDX, and others. We're going to be looking at a variety of different charts using MetaStock. I've got a number of charts that we're going to be pulling up and looking at specific professional breakout trading entry and exit strategies. Got a lot of really good charts here to work with, and I'm going to teach you some of the best things that I found in trading millions of dollars worth of stocks, ETFs, Forex, minis, and more over the years. So let's go ahead and jump right into it. As always, all information is for educational or information use only. I'm not making any buy, sell, or hold recommendations. You may have seen me an active trader, stocks and commodities. Speaking at the Money Show, I always have a good time. I'll be in Vegas again this November speaking. Let me ask a question, or one thing would be nice to know. How many of you are day traders? How many of you are swing traders? Or how many of you do a little bit of both? Or at least think to yourself what type of trading strategy you like to use in your own trades. Here's an example of a single day's trading making $600. And one of the things that I want to start off, is talking a little bit for 60 seconds about the importance of risk management. And it's all about taking real small stops on a very inexpensive broker that gives you light commissions and scaling into winning trades, so that even if you're right, my 30% rule is that your goal as a trader should be able to, as most professional traders do, and by the way, most professional traders are not right 90% of the time or some magic number like that. Most professional traders are all working on net profits based on scaling or position sizing into winning trades. So even if my message is one of hope that even if you're wrong more often than you're right, as in this day's trading examples, you saw the potential of walking out of Wall Street a winner. The key is scaling in appropriately on professional breakout trades. Now, if you are, so that's an example of a lot of scalp, $600 the hard way, scalping on intraday trading exits. Or if you're a swing trader, obviously there's better potential if you're trading large size. These are from real money trading accounts. Well, our goals for today, I wanted to teach you some examples of how to enter the very strongest momentum breakout trades using the MetaStock platform and some of the chart patterns that I like to use. Also, strategies for avoiding false breakouts. One of the things that you'll find as a trader, undoubtedly, is the challenge is staying clear of the false breakouts and getting in on the ones that are most likely to move. And you'll find that my strategies are based on simple price action, volume, and candlestick patterns. I do not use derivative indicators, like the MACD and stochastics and RSI and B bands and all that. What one of my colleagues, Tony, would call chart spaghetti. It's much more about the strongest entries and the way to do that in a way that keeps you out of false breakouts. The trades that look like they're going to work out, you get in and it goes right against you as soon as you put on the trade. We want to stay clear of that. So I'm going to teach you some of the things that I found, at least in my own actual trades, that have helped with that. We're also going to look at top moving candlestick and cut breakout trades, and also how to scale into winning trades with multiple entries, or scale in points that you can start testing out in your own trades. A few quick tips, and this is the last PowerPoint, I promise, and then we're going to jump right into the charts. I like to work off of today's charts. So I'm a real trader, so I'm not a PowerPoint guy who runs through a bunch of cherry-picked stuff. I like to look at the real trading mechanics of what today's markets are doing. Any professional trader should be able to do that. Work right off your MetaStock platform and look at the charts and tell you guys how to trade based on what you see. That's the hallmark of a true trader, not a PowerPoint guy. Anyway, I do have a few PowerPoints here for the first 6 minutes or 7 minutes of the presentation, and then the rest of the presentations, thankfully, on today's charts. We're going to look at multi-day highs and concept of in versus out days. One of the best tips I can tell you guys is only trade things that are outside of the previous day's range in trend. So if something's taken out a new high above previous day's high, preferably a minor gap continuation, that's always your strongest play. At least that's my most winning trades over the years. The thousands of trades have all been the out day trades, days in which the market's outside of the previous range. and stocks that are outside of the previous day's range. Just test it out for yourself. Cut out and stop trading things that are inside the previous day's high-low. Rule number 1 for professional breakout day and swing trading. Now, we're going to be covering both intraday and swing trading examples in today's session. So I'm going to give you a variety of different charts to look at and patterns to work with. What we're going to focus on are things like candlestick patterns, as my colleague Steve Nissen would teach, wide candles with cup pattern confirmations. A cup looks like the letter U, like that as in the word breakout, a letter U that takes out new highs. You want to specialize in buying breakouts combined with wide range candle patterns, and I'll teach you how that works with some of the charts that we've got. As a breakout trader, you want to focus on taking a lot of shots at the market and focusing on making many entries. Expect that you'll get many small stops, but you scale in that makes it green. That's the tip. That's, instead of doing 5 trades in your 5 favorite instruments, you might want to do 15 or 20 trades on lighter size and then scale into the ones that do work out on sequential breakouts. That's important. I've got a couple of strategies to cover called acceleration ramps and price action breakout trades, and always focusing on the upper right side of the chart. So with that, let's go ahead and jump into the charts for the rest of the session and see how to trade. Now, one of the things that I want you to look for, and we're going to jump into the intraday charts first. Here's today, CREE is the ticker, and you can see from the beginning, this is my number 1 money shot player. My favorite trading setup is always going to be these minor gaps, like today, CREE, the ticker, okay? And you can see that it's moved up nicely. It did a minor gap continuation. That's my single favorite pattern. Very easy to spot. Minor, meaning less than 5% of price action. So you can see this thing was $60 and it gapped up to 60.7. Perfect. That's less than a percentage point. So that's a really nice breakout continuation. The trick is for breakout trading that works, at least I found, is you look for a wide range candle. See how the whole real body of this candle is relatively large compared to the closing range of the candles on the previous day. This is 2 days. This is the start of this morning today, and this was yesterday's close, right into the yesterday price action. It moved up nicely, and again, for a swing trade, it's fine to buy in anywhere. I like to use 35 to 50 cents above the high of the candle to scale into my trades. That's a classic pattern. That's the number 1 thing I want to teach you. I mean, can everybody memorize that pattern? You have my word. It's the very, very best play. It's what I tell friends and family, as well as thousands, well, now up to tens of thousands of traders throughout my network of sites. Minor gap in trend continuation plays to scale in on sequential moves. You scale in, I'll go over some of the rules of how to do that later, but the number 1 thing is minor gaps, buy above the first candle, okay, and this is a 2-minute chart, 2-minute candles on continuations. Now, who can tell me what that chart pattern is? How many of you can recognize that chart pattern? Name that candle. That would be a shooting star. Learn how to trade candles from Steve Nissen, my longtime colleague of over a decade. He's a great guy. I make a lot of money thanks to what I've learned from Steve and how to actually use the professional candle patterns. So I use things like Western. In candle parlance, we'd call it a minor window. I do not look at that as a reversal signal. Okay, morons teach people that you should always sell a gap up and buy a gap down. No, Sparky, that's not how professionals trade. That's an institutional buy signal, guys. When the market, now, if it gapped up 6 points, then no, I'm not going to buy that. But if it gaps up less than 5%, less than a point or so, I'm in. I always like to buy these on new highs. Now, if you're day trading, you put a stop loss at 8 cents under the nearest, low of, if you see a shooting star, or if you see 2 sequential red candles, that's an exit signal. Or if you see a bearish engulfing or any of the other reversal patterns, that's a good way to scale out of a trade. Then, how do you trade on a breakout continuation? Well, I do not, and again, here's a perfect hammer, okay? So if you do like to trade pivots, you can take a shot at right above the hammer high. And again, this is just, randomly pulled out of today's markets. This is the first time I've gone over this chart today for anyone. So, and I just instantly see the signals. So they're very easy to spot. Minor gaps get the party started. It's an out day, an out range breakout trade. Specialize in that. You have my word. It's the number 1 pattern. I've been a professional day trader since the 90s. I'm one of the original .com guys. A lot of people have copied my university and mastery concepts. I founded the original concepts of those, you can check the domain registries to see who was there first. And anyway, my point is, look for minor gaps that continue to run, and you can scale in every 30 to 50 cents on $60 instruments. If you're trading $20 instruments, every 10 to 15 cents. But you look to nudge into those trades on minor gap continuations. Sell at the first sign of weakness, 8 cents or so under a shooting star, or buy right above 8 cents or so above the high of a hammer, right? So that gets you out, back in again, and we're off to the races. If you're a swing trader, you just put an entry trigger of roughly 30 to 50 cents. If you want to use a default, I use 35 cents in my own trades and in my own accounts. But anyway, I use buy stop limit orders, and you just park it and forget it. 35 cents above the first candle high, and that gets you in, and then you just set and forget it and let it, take out new highs for you. And that's how you trade breakouts. Now, if you want to scale in, okay, what's the high of the chart here? Well, you just add, say, 35 to 50 cents above the 2-day high to scale in. And that's one of the things you want to look at for an intraday chart. Here's another look at it. In this one, let's go back just a little bit further. Notice, please, that gaps almost always continue. For proof, don't look at any vendor's cherry-picked charts. Look at the S&P, the Dow, and the NASDAQ. Look at the indice charts, and you will see that the vast majority of the time, 60, 70% plus, gaps will continue in the trend of the gap in the broad markets, in your sector ETFs, anything else that's gapping. So a gap down will usually sell down. Gaps up, continue up. Gap up, continues up. This is CREE on a multi-day. This is about 5 days worth of data. Anyway, what you can see is very clearly marked out cup patterns. And what the bane of traders is, here's an inverse head and shoulders down here, right? The left shoulder, the head, the right shoulder. That would be the buy signal above that. And that's, I don't like digging around on the left side of the chart. That's kind of too easy. Anybody can do that. The trick is, I only get paid if I'm right on the upper right side of the chart. So going back in history, I guess it's of modest use for you to see the patterns. Notice, please, the cup. To make a cup pattern, I always get this question, Ken, how do you develop a cup? Well, excuse me, just look at minor recent highs and lows, and when you're trying to establish an entry trigger, notice, please, that this is the left anchor point for a cup way over here several days later. That would have been a false breakout if you didn't use my 35-cent rule, right? So where traders get into trouble is they may say this, okay, they'll look at that and do old school here. Let me get a notepad file and just move over. If you're following this thing, new traders would buy right there because it's a breakout above the previous high, right? New traders, and they'd get into trouble, and that thing would go against them, or likely stop them out on a pullback. So to avoid that, what I want you to start doing is add 35 cents to 50 cents. That's kind of a good range that I will use when estimating entry triggers above this price. So you add 35 cents to that to yield the trigger, and that gets you in on a good breakout that does keep going. Okay, so that's one of the first things to look at. Now, let me flip over to a new chart. Let's take a look at Adobe. From today. What do you notice about Adobe? Hey, what a surprise. What did the gap do on high volume? Okay, amateur traders and those who follow educators who incorrectly tell people to sell the gap up, morons, lost their shirt. Guys like me, we trade breakout continuations on, I'm a specialist. I'm an expert in trading new highs. And so what I do is I will always buy minor gaps up. That's what you do as a trader. You're always looking for minor gaps and you scale into the trade on continuation moves. Now, if you see it, for example, shooting star there, you know not to buy until it breaks out over the high of that. So we didn't get out a new high. So now we know here 46 is major whole number resistance. So I will likely buy this again over, say, 46.10, maybe 46.20. Okay, I'm always buying new highs. I specialize. My expertise is in how to correctly buy the upper right side of a chart. That's what I do for a living. I buy the upper right side of the chart and I buy in again on continuation moves. The trick is staying clear of false breakouts as often as you can. And the other challenge that you may find is, how to say, the department store mentality of, hey, well, it only used to cost 43 bucks. Why should I pay, 46 bucks for Adobe? Well, look at any breakout chart. It could well and easily go up to 52 or 60 or $80 or whatever it is. As a professional breakout trader, I'm always keenly interested in something that tells me I've got institutional money flow. These are the MOO order flow, the market on open orders, they're called MOO, or market on open orders. That tells you, that's the kind of the tipping of the institutional high frequency trading algorithms that get you into dark pool continuations versus fake outs. We want to ride on the tails of professional institutional guys. So they're out there making a big bet long here. You buy right above the first candle, okay, a new first candle on a new high. And that's how you get into a trade. It's fine for scalping for a day trade. You get out at 8 cents, and write this down. It's good. And again, no, I'm not selling any software. There's not going to be any sales pitch for anything at the end of this, okay? I just want to earn your goodwill and your trust by giving you professional stuff that you can actually use. Anytime you go to a webinar with anybody, ask yourself at the end, was the guy trying to sell me something, or did he actually give me some specific things I can use without having to buy anything else? Okay, and that's what I'm doing for you. I'm giving you exactly what I would, tell, new colleagues, friends, family, anybody I'm trying to teach how to trade. So anyway, so it's a rider downer. When you see 2 red candles in a row, okay, that's a contrary signal. If you see a bearish engulfing or shooting star, there's no bearish engulfings on this chart that I can see. There's a shooting star right there. And we do have, however, 2 momentum red candle pullbacks. So you sell it, say 8 cents under the second candle low. You can use that for any chart you trade, for intraday trades. For swing trades, you just buy it and keep in along and use a stop loss of no more than, say, 30 to 50 cents under the opening range of the day. So if you're looking at open range breakouts, as initially popularized by Tony Crable with commodity trading many years ago, he's the originator of the concept. What you want to do is look for opening range moves following minor gaps, like Adobe today, right? Now, this is what I trade. It's my specialty, is high volume, okay? If the volume had only been, say way down here at the closing range, say, 5,000, 10,000 shares, I wouldn't be all excited about it. But the volume is up at a huge spike here, right? We've got 35,000 per 2 minutes. A really good high volume gap continuation play. And if you're a swing trader, even, for example, let's say you're a swing trader and you missed it. Okay, well, no big deal. No harm, no foul. I would buy it at, say, and again, not a trading recommendation, but I'd buy, say, 46. For a new trade, I'd put in, say, 46 and a quarter with a stop loss of 45.6. Never used, by the way. No discussion from any professional trader would be complete without telling you exactly what stop levels to use. Okay, for E-minis, 6 ticks. If you're using wider stops, then you're being trained by somebody who's not a professional trader. Ask any floor trader. Anyway, 6 ticks, a handle and a half on E-minis. For Forex, no more than 20 to 30 pips. For stock day trading, never more than 40 cents. And usually I like to keep it within 8 to 20 cents for my trades, at least in my own day trades. For swing trading, stocks and ETFs, never more than 1.5 points. And I usually like to keep it within a point. So, having said that, say 46 and a quarter would be great for a new breakout to scale in for position sizing, as my colleague Van Tharp would call it. You just add to your trades at roughly every point on each breakout above each whole new number. So it would be, say, 46 and a quarter, maybe I'd buy 100 shares. At 47 and a quarter, I'd buy another 100 shares if it keeps going on up. If it chops and drops, I put in a tight break-even stop, or for the initial stop, if I buy 46 and a quarter, I would never let it go anywhere under 45 and a quarter. That's a 1 point stop. I would most likely, let's see, 40, I think how I'd manage to trade. I'll likely put this off at one of my own accounts. 46 and a quarter, I would use 45.50 because that's right under the support of this congestion region. So I would buy 46 and a quarter, put a stop at 45.50. Now, sometimes, you have to go fishing for the trade. Sometimes it will do that, and it will stop you out. Well, I would buy again at a new 35 cents above whatever the high was that it took out on a sequential breakout play. Now, one of the things you want to look at, let me zoom in. It's one of the things I like about MetaStock. You can see how to zoom in on this stuff really easily. It's really neat to see. Look for this pattern where you see sequential candles that are getting bigger. Kind of like the concept of an ATR, or an average true range, or average trading range, on daily candlestick charts. For professional momentum entries for swing and intraday trades, remember I said you look to see if rule number 1, okay, who can remember? What does the first candle on a minor gap, and again, this is not just all about gap trades, but they're the best trades, so I want to give you the best ones, Adobe and Cray or whatever, the first 2 ones. The whole real body of the candle is larger, at least twice the size, the whole real body of the closing range of the candles in the previous day's close. And you can see that's the case, and you just buy at new highs above that candle. It's even better if you see a sequence of 2 stair-step type candles, almost it's kind of a 2-line break, not a 3-line break, but you see a stair step where the second whole real body of the candle is larger than the first. That frequently, I'm a former corporate quality engineer and statistician, Baldrige Award examiner, used to be a corporate guy working for big companies like Ford Motor, Rockwell International, McDonnell Douglas, Sheraton, Chevron, a lot of client companies I had back when I was a corporate quality guy, and I like to use control charts in manufacturing and engineering. Well, in our equity trades, we're looking for things that are going out of control or breaking out to new highs, because that's how we profit as traders, is buy, say buy there and sell here, right? Or buy here and let's say you sell there, you buy again, maybe take a small stop, then you fade to a swing trade, you get in, and now the trade's kind of gone flat, and you're wondering if it's going to keep going up or not, and you manage your entries and exits with the correct professional position sizing. It's a refreshingly, I won't say simple because there are a lot of nuances, but it's a very focused, strongest chart only approach that I want you to start looking at as an active trader. So anyway, the point is, if you see that pattern, that's another one, another arrow in your quiver, right? No special plugins needed, no special green arrow, red arrow, magic software subscriptions needed. Just look for that. The best tool, the best way to learn how to trade, who can tell me? The best way to learn how to trade, there's no substitute for sitting in front of the dang charts for a lot of years and watching tens of thousands of charts go up and down for the last 15 years like I have, and like many of you have. There's no substitute for that experience. That's seat time, okay? What I can give you are things like patterns. I'm a professional pattern day and swing trader, and give you the patterns that I have in my own playbook that I use in managing my own thousands of trades over the years. And that's another signal that another clue with high volume. You see 2 high volume candles. The volume of the second candle is larger than the first. The whole real body of the second is larger than the first, telling us that the odds of it going up above that are very good. And you can see from a focused breakout standpoint, really nice move up. So that's the type of pattern you want to look for. Now, let's take a look at uncertain charts, because one of the challenges a lot of folks have is dealing not only with false breakouts. And again, I taught you what to do. If you had used a 35-cent filter, let's say you were, let's say this was a chart and this is the first time you looked at it was with this much data. Now you're wondering, question mark, where to buy? Well, just use as a default 35, maybe 50 cents above the high. And that will keep you out of, or frequently you'll find, just test it out for yourself. I think you'll be very impressed, as all my thousands of traders are. Often it will keep you out of a minor false breakout, because again, that's less than 35 cents above that high. You wait until, so you don't get suckered in by the market makers and specialists trying to trap you in gun stops, which they do, right? I mean, there's kind of like in poker, if you have to look around the table and wonder who the fish is or the mark, that would be you. And you don't want to be that guy or that lady. You want to be the trader who knows how to correctly separate out the strong breakouts from everything else. Okay, so anyway, if we're looking at previous high, it's there, that would keep us out of trouble. Put the new high there. Again, that's not 35 cents above, so that wouldn't activate on a breakout. But aha, here it did. And sure enough, lo and behold, the gap continued. And it kept running on up another 20 points. Okay, and that's Tesoro over a multi-month chart for daily chart, right? For those of you who like to use daily charts. And that's one of the neat things in MetaStock. You just sit here and click through and you can expand. I like that. It's kind of like a magnifying glass approach. And what you're looking for are these sequential cups that take out new highs. Very simple, guys. Don't make trading harder than it needs to be. The vendors out there who are trying to sell shiny new sparkly things that you don't need do try and make it there, and they're trying to make it a cherry pick out the holy grail, and hey, well, look how many times it would have made winning trades with it. No, the only thing that works is from a variety and reliability standpoint, statistically speaking, you're looking for reduction of alpha and beta errors. I won't make your eyes glaze over statistics talk, even though I could. Main thing is, does it work consistently most of the time, regardless of what you're using it with? Okay, so it's not, and that's the big thing that the vendors don't want to tell you is that, I mean, I guess technically I'm a vendor, but I'm a real trader who became a vendor, and it's a big difference. What you need to do is test out the reliability and validity of what the guy is telling you over the course of, say, 10 or 15, 20, 30 different test trades, which you should do to vet out the validity of what you're being taught. I strongly encourage you to be a passionate fan of testing and experimentation, very simply using the very best charts. Now, What do we see in terms of pattern recognition here? Now, a lot of traders will get into trouble as they will say, and this is almost a hammer, we got a kind of a shooting star there, but this is not something I would buy. If you are taking too many stops, wave a magic wand on your charts and just stop trying to buy dips and buying inside range stuff, because it doesn't work out very well. That doesn't end well. It's a story that has an abysmal ending with 90+% of traders washing out because they overtrade choppy charts trying to get something on the cheap and hope it works out. Well, yeah, but what if you say, look, hey, look cheap here, so I'll buy there. Oop, got to stop out there. Bought it there and got tired and didn't profit from the run up. Oh, so I finally buy it there, and when I get stop out there. Does this sound familiar? You know, I've made every mistake in the book and then probably a few hundred more. I'm absolutely not ashamed of all the mistakes I made back in the 90s learning how this stuff actually works. And what you find out is, over lots of years and millions of dollars worth of stuff traded, keep it simple, keep it strong, focus on the very best price action breakouts, simplify your life as a trader, and spend a lot more time on position sizing and scaling. One of my favorite quotes by myself, from a popular spy thing movie. One of my quotes from myself is, focus a lot more on the math than the chart patterns. Focus a lot more on the math. Use the charts to scan visually for the trades that you're going to get into, but focus your energy on your unrealized P&L and your brokerage account intensely once you're in the trade, because the money is all that matters. That's, your brokerage account doesn't care if there, well, it was a support line there, I thought it was going to hold. No, what you want to do is keep real small stops trading the strongest breakout signals. So again, look for those strongest 35 to 50 cent runs. Now there's more patterns to look at, so I want to jump into them here for you. One of the things I want you to do, therefore, let's take a look at Tesla. And a cool story, if you read the story I saw a couple in a showroom, the electric vehicle. It's the first real success story for EVs, and you can see founded by the former PayPal co-founder, now electric vehicle, and it's almost tripled in price in just 3 months, right? From a base of 25 to 30 to 120. So anyway, these kind of charts will frequently get you killed as a trader. So don't trade these, okay? Do not, just say no. Don't trade things that have a 60-point trading range in the course of a week or two. That's a really easy way to wipe out your trading account. So there are some breakout charts that, on first glance, it's appealing because, the greed gland goes, hey, okay, well, there's a shooting star right here, okay, where I'm pointing at. If you bought the new high, hey, that would have ended well. Well, but frequently what you'll find is you'd be the trader that would buy here and sell there, okay, and take a stop. Then you'd buy there and then get stopped out there. Well, surely it's going to take off there and you get stopped out there. I don't know if that sounds familiar. Don't trade charts that don't have cleanly defined strong trends, right? I mean, it's kind of common sense, but I spend so many time with so many thousands of traders or hundreds of traders in my webinars over the years. Guys will ask me about, hey, can you pull up this chart and take a look? And I pull up the chart and I wouldn't touch it with the 10-foot pole because it's very, very risky. You don't want to start your trading life off on a risky endeavor. You want to trade stronger, more consistent charts. For example, this had been a perfect chart, Alaska Airlines. This thing had gone from 32 to 64. So that's a doubler, okay, in the course of a few months. And it had a very well-behaved, clean chart until, who can tell me what that candle is right there? That would be a shooting star. And then whenever you see a shooting star, sell no more than 50 cents for a swing trade underneath the low of the shooting star, because it's very frequently going to go against you. That's why I'm extremely grateful to Steve Nissen for teaching me how to trade with candles, because it works, okay? For example, here, technically I don't think it's a shooting star because it's not at the top of a run. Technically, I believe this is kind of a three-line break, these three candles. That's one exhaustion. You have a doji, a bearish engulfing, it goes down, bearish upper shadow at least, and that tells you don't touch it long until you got 35, 50 cents above that shadow, right? And sure enough, had bearish engulfing and it's sold down sharply all the way down here. Anyway, the point being, you want these kind of charts that have a strong continuous trend. And again, don't worry. One of the biggest problems that traders have is they worry about being the guy who gets, the sucker that buys the exact top. and that ends badly. Well, what I found, and that took me quite a few years actually, to be honest, it took me almost 4 years to get over that whole, I was always trying to guess at the bottom and get a bounce trade, but I found that the win rate is abysmal on that kind of chart. You do not look, unless you see, for example, a clean hammer pattern right off a moving average line that's confirmed by a price action breakout, and there's very rare exceptional bounce trades that work out. It's best to combine the candles with Western technicals for professional breakouts. So if you see a trend emerging like this is what I call a acceleration ramp, where something starts off with the slope of line, if you were to just visually draw it, and no, there isn't any special, well, can I buy acceleration ramp scanning software that'll do my thinking for me? That doesn't work, guys. Trading's a thing, you don't have to be a workaholic genius, or a statistician, or all three, but I can tell you it helps. But one of the things you need to do is figure out, I'm an old school day trader and swing trader, and one of the things you have to do is visually tear apart the chart. And the great news about that is it makes you independent of, vendors out there trying to sell you hooey. What you need to do is learn how to trade this stuff on your own. So what I want you to look for, okay, this is the pattern. Basing, it's how to say, a narrow slope of a line. A narrow slope of line like that then get another line here that then has a sharper angle. Does everyone see how that pattern works? You have a slope of a line, and again, don't obsess over I've got to connect the dots exactly right. Don't worry about it. That's not what real trading is all about, throwing a lot of high probability darts at the market. Like in poker, I play tournament poker. One of the things I do when I go to Vegas for my poker tourneys is, I'm looking at strong starting hands in position and all the rest of that stuff you do. For those of you who like following World Series action in poker. Anyway, in trading, you're looking at throwing a lot of darts at the market that have high percentage setups that are visually, instantly recognizable to you as a trader. And you want to wean yourself from being dependent on vendors. Now, I'm not on many vendors' Christmas card list because I teach people how to do things independently of anyone, myself included, and that's really important that you get that right. That's why I got the trust of so many thousands of people, which I'm grateful for. Anyway, narrow slope of line that becomes a sharper slope of line. This is a daily chart. Now, you can use the same pattern on a day trading chart too, but for swing traders, look for a slope of line. This is, 15 degrees of slope. This might be 35 degrees, just eyeballing it. I'd be surprised, by the way, if that's off more than 2%. I've got a professional's eye on this. But anyway, slope of a line that's a narrow, kind of a bunny slope. I live in Colorado, so if you go up to Aspen and Vail and Boulder and whatnot, not Boulder, but Aspen and Vail, anyway, you have a bunny slope that becomes a sharper slope. Those are usually good to get in on anywhere, again, at new highs, 35 cents above previous day's high. When you see two red candles, you get out, okay? Right under the candle low, the second red candle, get back in on 35 cents above the high, 50 cents if you want. There's nothing magical about 35 cents, but that's what I use myself. Anyway, and then the slope of the line gets sharper and sharper. Okay, now what's the first sign of trouble? Well, okay, there's trouble. That's trouble. It's a shooting star. That's not good. Oops. Well, we better get out of that trade. You don't stick around. You put a sell stop order right after shooting star, right? That's kind of obvious exit, right? Anybody should have caught that. But if you didn't catch that, hopefully that kind of woke you up. Hey, that's time to get out. Like one of my articles in equities.com, I called the exact market top on May 21st. I told everyone to start locking in gains and scale out of their trades on the day before the market started selling off. Similarly, market, like Steve would say, the market leaves clues and it tells you what it's going to do. So sells off, good place to get off the boat there on any continuation play at the first sign of trouble. Now, when it starts misbehaving like all of this, this is a really bad time to trade this because there's no story. Think about it. I've got lots of buddies in law enforcement and the military, and if you work with detectives, right, at POs and they're interviewing a perp, they're looking for clues to see if all the story elements add up or not. And any one out, if you know professional interrogation techniques, not that that has anything to do with trading, except you are looking for clues. You're looking for a story, consistency or inconsistency of the suspect's story. And when you're looking at chart patterns to trade, similarly, one of the things you're looking for is the story of buyers and sellers in that instrument. Now, as long as they're all in agreement, let's say you got three perps on a suspected break in. I was talking with a buddy the past week, so I hear all the stories, right? I hear all the cop talk stories, the LEOs. Anyway, law enforcement officers. Anyway, as long as it's telling a story that makes sense, you stay with it, right? Kind of like marriage and so forth. As long as it all makes sense, you stay with it. But as soon as it starts getting wacky, you show at the front door. Speaking from experience there. Well, anyway, this thing doesn't have a coherent story. I have a shooting, or how to say, the shooting star there. I have a head and shoulders decline here. I would not do well trading this, okay? I mean, I would likely, well, at best be a scratch trader in this, to be honest. I mean, I would not expect I would do very well trading that. It's kind of like, I don't know, playing in first position with the Jack-10 offsuit or something in poker. That's not going to end well. So what you want to do is stay clear of any chart that's like this. And again, this is, an engulfment. A momentum trader might want to buy it here or short it there. And for a day trade, that's fine. But given that the story of buyers and sellers isn't coherent here, you want to stay clear of that. That's a very important strategic point for professional trading as well. So much to share. Now, one of the things, let's take a look at Green Mountain Coffee. This has been a success story. By the way, what do the gaps do in Green Mountain Coffee and virtually everything else? Not to beat a dead horse, but gaps up, continue up, guys. Gaps up, continue up, okay? Nope, shooting star there. We got some bearish shooting star there right before the drop. It's very obvious. Anyway, what you're looking for are sequential cut pattern breakouts to scale in, and that's a very simple way to trade. And it's what I've been doing. I've traded millions and millions, and somewhere over $6 million worth of stuff since the late 90s. And anyway, the point is, of the millions of dollars stuff I've traded over the years, I always depend upon candles to get me out near tops. Okay, that's the main benefit I use candles for, is to tell me when to start scaling out, and also to avoid a false breakout. If I see a shooting star, obviously I'm not going to buy anywhere inside the tail or the shadow or the wick or whatever you're going to call it, of the upper part. I will instead set a buy stop limit order 35 to 50 cents above, so don't get sucked in by a false breakout like that one. 35 to 50 cents above that shooting star high, right? And that's what gets me into a trade and stays blissfully clear of or free of false breakouts. And again, this is a reasonably well-behaved story. The story of Green Mountain is one of, hey, they're buying this thing, right? And again, this is over many months. The last couple of months, hey, they're not quite so sure, so I want to wait until that shooting star high gets taken out. And I would use, on this case, we're at 83. I would wait until well over, say, 83 and a half, maybe 84 even, based on the volatility. Now you can see a hammer right there, which told you to buy. If you're a pivot trader, to sell right under the low of a shooting star and buy right above a hammer, right? And that's good, obvious trading, and would have worked out fine as well for those who are pivot traders. So, the trick is combine all this into a very simple, very effective, very logical story that makes sense. Does all this make sense so far? I'm going through a lot of things quickly, but I want to give you the best of, this is kind of like the best anthology of lessons learned of a real trader, a guy who actually trades, of many, many, many years of experience, and things that you can start using immediately, say tomorrow, in your own trades. I want to give you genuinely useful techniques that you can actually run with and start using, and not do any kind of, oh, and by the way, wouldn't it be great now if you could have all this thinking done for you, that pesky using your brain part of trading for you, and buy my magic $1,000 software and it'll do it for you. Duh. That's derp. That's not how professionals trade. Neither should you. If you're a market mechanic, if you're a pro, you got to know your price action patterns, and you got to know how to trade this stuff without crutches. You have to think. You're either trading against a guy like me, may powers that be have mercy on your whatever, or you're trading with a guy like me, and you want to think like a professional trader, mechanic. What are the odds of something moving? Now let's get into another breakout or breakdown technique. Here's one. All of the gold miners, Newmont, AB, that's got ABX. This one's NEM, GDX. The gold miners all took a big dump today. They did a gap down, so they'll likely drop. I would not buy unless it recovers this hammer high over 30, for example. So just test that out, okay? Remember Calhoun said Newmont breakout trigger, I would use, say, 30.50, 30.5 for a long. I'd rather just short it down here at, say, 26 and a quarter, hit it again, short at 24. It might go down to 10. I don't know. It's been a story of selling all down here. Don't be the wise guy who says, well, it was way up here at $57, so it's only half price now. It's on sale. Maybe I should buy now. That's what we call a amateur losing retail home traders department store mentality. It's on sale, so it must be a good value, because surely if it only comes back here, then I could make some money. No, professional traders have been selling this thing to the public for the whole last year as it's been dropping, as the price of gold has dropped. So it's a great time to look at shorting gold on continued weakness in gold if it does keep dropping. Again, that big if gold consolidates and bounces tomorrow, then of course we don't want to short. But Newmont's been going down. So how do I trade that? I do not like to swing trade short. I'm all about risk management. I trade to make money. I don't trade to look at freaking chart patterns. I mean, that's part of my job as a trader, but ultimately I like to position scale and work my order flow so that I can make money as a trader. That's what I get paid for. So I need to figure out where the odds, of potential success in trading. Anyway, so what I like to do is, here is the GLL. Okay, this is GLL, the ticker, and this is the gold short ETF. A bit pricey. I would wish that they would do a 3-for-1 or 4-for-1 split to get the share price back down, and they frequently do that. By the way, ETFs, it's one of the frustrating things about trading ETFs. I was short the market on the flash crash day, by the way, and I got proof on my forum of actual live money accounts. So anyway, the point is, they frequently either split or reverse split the ETFs, continuously to make the price more attractive. So keep an eye on this one. Anyway, the point is, let's scale back here a bit, a couple years, as the price of gold skyrocketed, the inverse gold ETF dropped. This is what, 2008, so that's ancient history. But hey, it had been up at 300, 400 a share. Now it came down to 70 as the price of gold went up. Now as the price of gold goes down, who do you think's making all these big bets here? Who do you think is buying? This is an instrument that goes up, GLL, when the price of gold goes down. Who do you think is buying heavily? Really smart guys about right here, right? Anyway, it's almost doubled from there. Well, anyway, who else has been buying highly here? We had a gap that continued up, another series of gaps that have continued. Zoom in on this. Every time you see a gap, you see this cut pattern continuation. Well, if the price of gold keeps dropping, I guarantee you I'm going to continue trading GLL to the long side, because, look at the previous resistance. I don't know it'll get way up there, but, remember I said that. Remember Calhoun said that. One of my traders called me the NASDAQ Nostradamus at one of my seminars for a reason. I like doing my Vegas seminars because I like to make those fun. Anyway, but the point being, when the price of gold drops, so as breakout traders, we're looking for gap continuations, right? Gap up, continued, gap up, continued. Did a minor fade back to support, but the gap here continued. Big picture, gaps continue, and it keeps running on up, so I want to buy this on new highs as well. The point that I want to make in looking at this for you, not to make a trading recommendation, but to tell you to look for those type of divergences, or in this case, those type of, what you call an arbitrage play. As the price of gold and gold miners like Newmont and the others drop, the short ETF will make an inverse play to the upside. So instead of, I don't like short swing trading. I do not like holding anything short overnight. I refuse, because, what if there's, I don't know, Google buyout and it opens up, or whatever. Let's say, it wouldn't be Google, but some precious metals commodity company, whatever, tenders a buyout offer and it gaps up against you. That's how short swing traders get killed, right? Not only does it wipe out your whole trading account, but it also make you owe the broker some money too. And you don't want to have them showing up at your door doing that. So I've heard all the stories. So I do not swing trade to the short side. Instead, I like to trade the inverse of the bear ETFs like GLL and the others like QID and SDS and FAZ and others on market drops. Anyway, so that's just another breakout strategy, is if you see weakness in one set of instruments, see if there's another that's profiting from that. It could be an inverse ETF or something else that's going to benefit from the weakness in that price. For example, Redbox and Netflix are often at odds with each other. So it's Coinstar, CSTR, and NFLX, because they're competitors. When one goes up, often the other will drop. So that's another good breakout strategy to look at as well. So momentum breakout techniques we're always looking at, and if I can get you guys to avoid trading inside congestion regions, I will have done you a big favor, because that's where traders overtrade choppy instruments. And that doesn't end well. Trying to guess at highs and lows, excuse me, and doing several hundred webinars this last 8 months. It's many broadcast hours under my belt, so I apologize if my voice fades here and there. Anyway, congestion regions, if you see a hammer, you can always buy right above a hammer. If it's somewhere near support, that I don't like because it's not right at support. But if you see a hammer at support, you can buy right above it. If you insist on being a reversal or pivot trader, and obviously if you see a bearish upper shadow or shooting star at resistance, you sell right under that. I like to just buy new highs. I mean, that's what I do. That's what I trade for a living, is to buy new highs. So I like to get in. Now, I'd be nervous long right here, right? I'd be nervous long on this trading day. Let's say I bought in at my 35 cents above on, what is it, Samgen. Okay, let's say I bought here. I'd be nervous long on that day because, let's zoom in, make it easier to see. I'm 49. The older I get, it's an 8 diopter correction. So glasses and contacts are my life. So if you're like me, a middle-aged guy, it's nice to have things wide open. Anyway, I'd be nervous long on this day because of the shooting star on the previous day. So that tells me that there were some sellers coming in, and I would put a stop right under support there, right? Now, it did hold support, thankfully, and it kept running on up. Where would be the first exit signal? Given what I said, I don't see any bearish engulfings, but the gap down, that's the first exit signal. So if you'd bought here, say on the breakout continuation, or you bought the day that turned into a shooting star day and nervously awaiting to see if it's going to keep getting legs, when you see a gap down against it, it's still an in-the-money trade if you'd bought anywhere in here and scaled up, but you'd put a stop loss again at right under that gap day low for a swing trade, maybe 50 cents on something this expensive, $100 share instrument. I would use 50 cents or so under the gap low, and that way if it keeps dropping, which often it will, then you get out. Now if it keeps holding its own, see, it did finally drop, so that would get you out of the trade there. So you're in here, or actually more specifically in on the new breakout day. Let's say you got in here or here, hold it long and it starts to sell down, then you get out right there. And because again, more selling coming, when you have a gap down, that usually continues down, right? Just like gaps up, like this one. See this gap up? Classic Calhoun breakout gap runaway move. You can see a minor gap up that kept running on up. Here's a gap down, eventually kept selling on down. So that's a good way to manage your entries and exits and kind of navigate the chart patterns visually as a breakout trader. And that's the the type of thing that experienced traders do. And it's like, look, Bob, no special indicators needed. It's all about price action, volume, candlesticks, Western technicals, and the rest of it. Makes for, test it for yourself. I think you'll be very impressed. You say, okay, he told me, what did the guy tell me? This stuff is good. I got to write this down. What did the guy tell me? Okay, well, what the guy's telling you, what I'm telling you is focus on these minor gap continuations that are outside of the previous day. Wave a wand across your trading and resolve, or at least keep track of it, and you will find, I think you'll be extremely impressed once you test out, say over your next 100 trades or next 20 trades, get a representative sample, at least 20 to 50 trades. So you will find that most of the entries that you enter that are inside the previous day's high-low range end badly, and you take stops or very small, modest wins at best. Those that you enter that are above the previous day's high at the time of the entry, again, at least 35 cents, no less than 35 cents above the previous day's high. The reason that is, by the way, I am an old school, those of you guys remember fraction days, that's about 3/8 of a point, or 3/8 of a stick. We call it on Wall Street. My institutional guys, we call it 3/8 of a stick. That's 0.375. I just round that down to 35 cents because that's close. The 3/8 of a point is kind of the magic point for any professional day trader or swing trader, and using mostly intraday trades, but 3/8 of a stick above the previous day high, that's what gets you in. If you see a shooting star, that's what gets you out. If you see a hammer, that can get you back in, and so forth. The cup patterns are always the minor gaps or minor window continuations are the best. Cup continuations with the suitable false breakout filter, again 35 cents or so above the high, is the second best trigger. And then a series of whole real bodies of candles, they're getting larger, they're telling you a story that there's more buyers on the way, then that's good. Now, what's something that tells you impending problems is let's say we'll look at both intraday and swings, but from a volatility standpoint, one of the things that tells you the trade is likely to run into trouble is a congestion region of narrow flat candles as if somebody stepped on them, kind of like doji patterns, whether it's the dragonfly or gravestone doji, or just regular straight, looks like a plus sign doji. That's a gravestone doji. I don't know where, I don't see a dragonfly in there. Anyway, the main thing is if you see flat candles after big wide candles, that's telling you something about the lack of conviction of the buyers to come in and step up to the plate and continue buying that thing up, to bid it up. So what you want to do is, once you see, let's say you get in on whatever, any of these breakout signals, the first one, which is right after the first wide whole real body candle, let's say you get out at the first sign of trouble, the shooting star, you get back in on a new breakout, but you start to see some flatter candles after a couple of big candles. That tells you to tighten in a trailing stop to get out of the trade sooner rather than later. Again, this is all based, I'm teaching you professional, how do you say, pattern day trading or pattern, well, I've covered both swing and day trades, but you're looking at professional, precise pattern trading skills. And again, with MetaStock makes it easy. That would be a good tagline too, Jeff. Write that down. MetaStock makes it easy because it's alliterative, the M's. And anyway, my point is, you can use that too. I won't send the bill. Anyway, the point is, we're looking for the strongest of the patterns, and you probably will. No, I don't know if you guys will, but anyway, looking at this, one of the things you're looking for, moving right along, when you see this pattern, for example, memorize this type of pattern. When you see a large candle followed by, this isn't quite a technical three-line break. For more on three-line breaks, see my colleague Steve Nissen's book, Beyond Candlesticks. He's got 17 pages on three-line breaks. It's one of my favorites. You want to, so I should probably find a technical one. It looks like 3 candles in a row, and the selling pattern is one in which the third whole real body is narrower than the first and second. That tells you it's kind of like Papa Bear, Mama Bear, Baby Bear, Itty Bitty Infant Bear. Anyway, that tells you it's likely to go flat. So that's a good time to scale out or tighten in a stop and take some money off the table. And always buy a new high breakout if it keeps running. Frequently, though, they won't. They'll drop or do one of these and drop and chop. So if you get in on, say, a nice breakout that then goes flat, it's fine to get out of the trade at the first sign of a pullback. So look at the whole real bodies of the candles, either on a daily or an intraday basis, and use that to help navigate your breakout trades visually. Now, isn't it good that you learn this? You know, and this is all stuff that I'm giving to you as free professional trading tips that a real trader uses, that you don't need any, you know, special indicators or training, you know, beyond what I mean, of course, I offer additional training, but, you know, what I've given you is, can make a huge, potentially make a big difference in your trading. Just test it out. I stand behind it. Test out what I've just taught you. Looking at outrange days, looking at whole real bodies of candle patterns, looking at these cut patterns with false breakout filters. That's the best of what I've learned in my own actual trading experience, and I hope that it's something you can take to the bank in your own trades as well. And I'm sure, you know, traders are, well, is there any way I can get confirmation or make it easier or automate it or all that kind of stuff? No. Welcome to professional trading. You got to scan through a few hundred charts every week and figure out where the money shots are and take your shots. That's the work that you got to pay as a trader, is you got to figure this stuff out. You don't pay some vendor to handhold you and give you stuff. I mean, or at least not for any length of time. You should try and get to independence as quickly as you can as a trader. Of course, the other people who are in the industry don't want me to tell you that, but that's one of the ways I build genuine trust with traders, is I give it to you guys straight and tell you what you can really use. That's why I got traders with me for 6, 8, 10 years, because they know they can count on me. Anyway, look for, this is a Forex example here. And see our pound dollar, the cable. Look for these bearish cup patterns, right? This is a bear cup. The trick is, does the bear cup continue? When in doubt, get out. Again, use a tight 20 to 30 pip, you know, cover stop. But anyway, you see a bear cup play, you might want to get in, say 20 pips under the left side of the cup for a short. And let's say it moves down, you're happy, starting to move back up, you're not quite so happy, get out flat, right? Or use a 20 pip cover stop. Same thing for the stock and ETF and E-mini charts. Always become a master of using cup patterns visually, because usually they will give you something. Okay, this one gave a bid up before it bounced back into range. Other times they'll just take out new lows and grind on down in a nice healthy drop, right? And if you look at identifying cups, you know, how do you identify those? Well, that would be another cup support. It's now in the process of taking out yet another cup support on the cable. This is our British pound to the US dollar. So the US dollar, that means the dollar is doing good against the cable, so at least recently, so might be a good time for that trip to Great Britain. But anyway, we're at a new low here, so we want to just short new lows on sequential cup breakdown patterns. So that's, the inverse way, or that's a way to look at it for selling. And also too, by the way, if you're long in a swing trade and you take out a bear cup drop, then you want to sell right under that. So again, 20 to 30 pips for a Forex trade, 50 cents, 35 to 50 cents for a stock or an ETF trade. And that's, the heart and soul and the core of, at least how I as a real trader do things. Now, let me give you, another quick tip to tie it to real money trading account example. On the false breakouts, your goal is, and again, the false breakout filter approach, again, test and experiment. Don't trade cheap under $20 instruments, okay? Only morons and amateurs trade sub $20 instruments. Any professional trader, talk to any Wall Street firm, and they'll tell you that's what losers trade. That's the kiddie pool. Professional traders, we're all trading things usually between $20 and $70 a share, and we trade the underlying. You don't trade derivatives. You don't trade penny stocks. You don't trade cheap sub $20 stocks. If you've been doing that, how well has that been working out there for you? Okay, so enough said, okay? Time for a change. I will trade cheap instruments on occasion. You can see a few mixed in here, but most of what you trade, I should say, is over 20 bucks a share. You may trade some cheaper instruments on occasion, but again, you can see of these, this was a couple of years ago, I was trading some cheap instruments, and hey, not surprisingly, those are the ones that had the stops. The ones that are over 20 bucks a share, with a couple exceptions, but those are the ones that made the money. So trade instruments that have volatility worth trading. Make sure that when you are wrong, it's costing you these type of dollar figures, no more than say 30 to 50 bucks, okay? If you're swing trading, you should never take more than $100 stop loss. If you are, you're donating to a guy like me who's trading the other side and taking it from you, okay? Professionals feed on amateurs, and what you got to do is keep your shots, because again, you had to say $100 bought me all these chances of being right. Kind of like going to a carnival and you got carnival tickets. Itty bitty stops are the darts you're throwing at the water balloons or whatever, trying to take the shot. The ones that do work out, those are the ones you scale into, the position size. Okay, when you build a big trade, maybe it's 1,000 share trade and something that's moving, then you can scale up or get out. In this case, I was selling a gap up. There was a big gap up and made some money for me for swing trade. So make sure that you're using that as part of your focal point or your process as well. Trade instruments, by the way, what I like to look at and let me pull this back here. Trade instruments that have, at least 5 to 10 points, I would say at least 10 points of range on a monthly chart, okay, at least 10 points of high-low range. Don't trade something like, or at least I don't like trading things like, eBay and Intel and Cisco and Oracle. I like to pick on those and have for over a decade, but don't trade something that has a 60-cent trading range that only, the high-low on, say, a 10-day chart is only 2 points, because you're not going to make any good trades with that. You need to trade things that have juice, that have points that you can profit from or potentially profit from. So you want volatility, yes, but you don't want like the Tesla chart that's a 30-point runner. That's too much. You want these nice bunny charts, right? Easy to trade, strong slope charts. Okay, this is Tenet Healthcare. I've been calling this thing long the last couple of months for my traders. Anyway, you can see it's moved up. So those are the type of charts in terms of scanning for what you want to look for that makes sense. Last tip before I wrap is tried and proven. If you like, how do I find out what's worth trading? Guys, focus on 52-week high charts only. 52-week highs are the best. Because those are the ones that are attracting new institutional volume. So specialize in 52-week highs of stuff between 20 and 50, maybe 20 and 70 a share with enough points range to make it worth your while. And with that, I'm out. You guys take care. It's been a great audience. Thanks to Jeff Gibby, too. He's been a great guy to work with for a lot of years. I really appreciate Jeff's tireless efforts to bring me in front of all the traders. It's deeply appreciated. And I hope I've given you a genuinely useful, relatively fast-paced and engaging, based on real trading experience presentation that you can start testing out what I told you. And I stand behind it. I've done my own trades with this for many years, so I hope that gets you started on the path to doing much better and correcting what you're doing as a trader that's been wrong and getting in on more successful trades as you look at the very best of the high momentum breakout patterns using the MetaStock platform. Thanks so much. I'll turn it back over to you, Jeff, and thanks everybody for being here. I appreciate it.
Ken, thanks for coming. It's always great to have you. Highly recommended, guys. Ken's somebody that we've known forever. And take a look at him. For you, thank you for your time. We really appreciate your coming in. We hope this was valuable for you, and we'll see you at the next one.
Okay, thanks so much. Thanks, Jeff. You've been great as always to work with. And all the traders, test out those simple, strong patterns. Focus on those, and hopefully you'll be able to make great trades with MetaStock and the combination of the patterns I just gave you. Jeff, you'll have the video up somewhere sometime, right, so they can replay it, and that'll be something for them to look at as well, right?
Absolutely. You bet.
All right. Well, hey, thanks everyone for making it a winner, and do well out there. Trade smart, trade light size, scale up on the ones that work, take tiny stops on the ones that don't. Trading outside ranges, minor gap continuations, use the candles wisely, and be on the right side of your trades. Here's to bigger winners more often. Ken Calhoun, Daytrading University. I'll see you guys next time. Thanks so much, and I'm out. Bye, everyone.